Today we're taking a look at the alternate version of exercise 11-5 from page 520 of the textbook, chapter 11, Reporting and Analyzing Equity. This exercise is taking a look at stock dividends and stock splits. So on June 30th, 2016, Sharper Corporation's common stock is priced at $30.50 per share before any stock dividend or split, and the stockholders' equity section of its balance sheet appears as follows. So the company has common stock. It has an $8 par value. There were 80,000 shares authorized, but the company has not issued all of those shares. They've only issued 32,000 shares. So for those 32,000 shares, at its $8 par value, the amount credited in the common stock account is $256,000. Okay? The paid-in capital in excess of par of common stock is $200,000. So for those 32,000 shares of stock that were issued, the buyers paid more than $8 per share. The additional amount they paid totaled $200,000, and that's credited in the paid-in capital account. The company has retained earnings of $358,000, and so these three components together make up the current stockholder equity of the company of $814,000. So it says, assume that the company declares and immediately distributes a 100% stock dividend. This event is recorded by capitalized retained earnings to equal the stock's par value. Answer these questions about stockholders' equity as it exists after issuing the new shares. So first we're asked to complete the below table to calculate the retained earnings balance, stockholders' equity, and number of outstanding shares. So we have information related to the stock. We have the common stock at $8 per share, par value, the paid-in capital in excess, the total paid-in capital, which is the total amount contributed for the common stock, plus the excess, that equals the total paid-in capital, retained earnings, and then the stockholders' equity. We know before the stock dividend that there were these numbers. Common stock, as we indicated above, was $256, paid-in capital $200, that makes a total paid-in capital of $456. Retained earnings of $358 gives us our stockholders' equity of $814,000. Okay, so now we're asked to decide on the impact of the stock dividend. Well, what's happening with the stock dividend? They're going to issue, for every one share somebody has, they're going to get one more share. It's a 100% stock dividend. Companies might do 10% stock dividends or 20% stock dividends. In this case, it's a 100% stock dividend. If it was a 10% stock dividend, that would mean for every one share you'd have, you'd get an additional 1/10 of a share. And yes, you can own partial shares of stock. So this stock dividend is a share for share stock dividend. Each shareholder will get the exact number of shares they have now duplicated. So what we're doing with the stock dividend is we're essentially taking the value of the stock dividend out of retained earnings and just reallocating it back up into the common stock account. It looks like this. For the 32,000 shares with an $8 par value, remember how many shares are authorized? 32,000 shares, $8 par, so $8 par times 32,000 means that we're going to pull out of retained earnings $256,000. And where is that money going to get reallocated to? Directly to the common stockholders as additional shares of common stock. So for every share of common stock that stockholders had before the dividend, they're going to have twice that after the dividend. Therefore, the common stock account needs to double as well after the dividend is made. The amount of the dividend is taken out in its entirety from where? From retained earnings. So after the stock dividend, will there be any difference in the total stockholders' equity of the company? Well, no. We've simply lowered retained earnings and we've increased common stock. We have just shuffled around the equity section of the company's balance sheet. Now the totals will change in each individual line item, but the overall total for stockholders' equity, that won't change whatsoever. Let's recalculate. So before the stock dividend, there was $256,000 credited in the common stock account. Now with the stock dividend, another $256,000 is added, so total common stock after the stock dividend is now $512,000. The transaction didn't involve any additional paid-in capital, so we simply take the prior $200,000 plus the new common stock of $512,000, and we'll have total paid-in capital of $712,000. But look what's going to lower here. Retained earnings is going down by the amount of the dividend, so we'll take $358,000 minus $256,000 to get new retained earnings of $102,000. But does the total stockholders' equity change at all? No, not whatsoever. It is still $814,000. But how many shares of common stock are outstanding now after the 100% stock dividend? Well, it goes up to 64,000. Let's move on to the second part of the problem. It says, complete the below table to calculate the retained earnings balance sheet stockholder equity section, assuming that the company implements a 2-for-1 stock split instead of the stock dividend that we did in part 1. Well, a stock split is a little bit different from a stock dividend. The only thing that happens in a stock split is this. The par value is reduced by the amount of the split. In this case, it's a 2-for-1 split. So for every 1 share you had, now you'll have 2 shares. The number of shares outstanding, that doubles. So the impact of the stock split on the number of shares of common stock is this. It doubles by $32,000. There are no changes whatsoever in any of the other stockholder equity accounts. Common stock remains the same, par value remains the same, except look what happens now. The par value is no longer $8 per share, it is now $4 per share. After the split, the value of the common stock is still the same, there's just a lower par value, half of what it was, and higher number of shares, twice of what it was. Therefore, that yields the exact same credit amount in common stock of $256,000. Notice that all of the other accounts have stayed the exact same, and as a result, total stockholder equity has not changed either. After the share, the only thing that changes is the number of shares of stock outstanding is doubled, and the par value is cut in half.